Welcome everybody, this is Edgardo Balentine.
And this is Scott DiGregorio, and welcome to the Real Estate of Tomorrow podcast, where we're going to discuss the rapidly changing landscape of the real estate industry.
And the steps that you need to take today in order to survive tomorrow.
Look, I'm going to give you the perspective of a 25-year veteran, somebody who has been there and done that.
Which is a slang for old fart, okay?
Screw you, man.
Look, I'm going to give you a fresh perspective from somebody that's applying those steps today.
So that basically means you're young and you don't know shit.
All right, let's get this started.
What's up, everybody, and welcome to the Real Estate of Tomorrow podcast. I am Scott DiGregorio, and my co-host is
Edgardo Balentine.
What's up, man?
What's going on, man?
I thought you were supposed to say what's up there. We had like a brief second of awkward silence.
I know, it's late.
Yeah, you're screwing shit up. Okay, so dude, you almost screwed up the name of this episode.
No, I think the name is great. I think we don't know what the name is going to be. I think the name that I'm picking is, look, I want to call it creative financing.
And what he doesn't understand, because he's too freaking young to understand, is that the term creative financing has been demonized leading up to the 2008 housing crash. So we should call it something like alternative financing methods.
That's so boring. Alternative financing methods, bro. That sounds like something that will come out of an instruction manual. That's so bad.
All right, so look, legally these freaking loans are called non-QM loans.
Yeah, for the most part, the majority of the ones we're going to talk about. I want to sprinkle some DPAs in there too. But yeah, we're basically going to talk about all those kind of loans that maybe don't fit the normal person, you know. Normally in the lending world, things tend to be very cookie cutter. We like to think of ourselves as very creative when it comes to financing because we really understand the guidelines. But let's just be honest, you know, a conventional loan, a government loan, you have to hit certain things in order to qualify that doesn't necessarily align with a lot of common sense and people that maybe don't, you know, fall into those categories.
And look, the reason why real estate agents and consumers need to know this information is because I can't tell you how many times in my career I've talked to an agent about a program and they go, oh crap, I wish I would have known about that. I could have saved blank, or I could have helped blank, or whatever.
Oh my God. And a lot of times, you know, when you know these type of niche programs, because that's what they become niche programs, you end up getting a lot of clients that have been turned away by a lot of different realtors and lenders and have been told that they won't be able to ever qualify for a house unless they change this one thing that they're never going to change. And then you end up getting a ton of business from that. So yeah, that's super important for you to know that there's the possibility for these people that, you know, traditionally you've heard that they will never qualify, where now they can qualify. And trust me, again, like I'm saying, if you're the realtor, the lender, the title company, whoever that points them to this direction, man, you get a lot of business because where there's one person with that set of circumstances, they know a lot of people with that same set of circumstances. You can take advantage of that.
All right, so let's get into, we're not going to get super technical with guidelines and stuff, obviously, but
well, let's talk about the most common ones, right? So one of the biggest problems that we have when it comes to financing a regular loan, it's a lot of people that are self-employed.
Yep.
That they don't show a lot of money in their taxes, right? Because, you know, paying taxes is super expensive. If you are anything that has to do with a Schedule C, or you have your own business, or you are as you know, a contractor or something like that, an independent contractor, well, you might not want to declare all the income because by the time you know, shave 32%, 22%, whatever it is, it's a lot of money. So what can we do for people like that, Scott?
Yeah, now we are not necessarily promoting tax evasion.
Please don't do
any
that.
means, but sometimes people's accountants
Be a patriot, pay your taxes.
Sometimes people's accountants do get awfully creative. So look, for people in those situations, there are bank statement loans, okay? And basically, look, and let me do this, okay? And let me give everybody the historical perspective that your youth cannot give them. So
this is going to be so interesting.
The thing that caused the housing crisis was the subprime mortgage loans. And for those of you that don't know this, you were able to buy a $300,000 house, take out a $375,000 mortgage, literally put 75 grand in your pocket, and not have to even write down the name of your employer, how much money you made, and if you had any money in the bank, and credit scores as low as 500. Like, that's a bad plan. So
yeah, that's not creative.
yeah, that's called stupid financing. So the programs that are here today, and I think it's important to differentiate them, are not that at all. These are programs that make a lot of sense in the fact that they solve for a problem, but the other areas of the loan have to be strong.
You still need to qualify.
You still need to qualify.
We still require certain things. And I must say, one of my most qualified, like some of my most qualified buyers when it comes to common sense, when it comes to should this person have the ability to own a property, are the people that end up in these programs.
Absolutely. So bank statement programs, without getting into details, you could take either 12 or 24 months worth of bank statements. You take the average of their deposits and then use that as an income formula. Different programs have different formulas you have to apply to that number. The nuances doesn't matter, but instead of using reported income on a tax return, you look at the deposits in a bank statement. And I got to tell you, there's a lot of sense to this, Ed, because there's no, although taxes can be played with, right? You could make $100,000 a year and tell your accountant you made 150. I mean, that's a thing.
Yeah.
Hey, I also had $50,000 in cash sales, and inflate your income. A lot of people don't do that, but you could. You could certainly do the opposite of that and deflate your income. So just because something's on a tax return does not mean it is the facts. But if you have 2 years of bank statements and they're averaging deposits of $10,000 a month, they're bringing in gross $10,000 a month, and that's pretty hard to argue against.
Yeah, and these bank statements, by the way, are underwritten. By that I mean, you can't just have, a separate account where you take money out and put it back in and take money out and put it back in. Like, they're underwritten. So yeah, like you're saying, for the most part, that ends up being a more accurate account of of somebody's income than their tax returns. So we can do that, and these loans have the ability to do that. Again, not to get super deep in guidelines or anything like that, but yes, you can do it with business bank statements. Yes, you can do it with personal bank statements. Yeah, you can do it with a combination of business bank statements. So there's definitely an option for people that don't report a ton of money in the tax returns. Another sister of that program is the 1099 loans, where basically we're doing the same thing, but instead of looking at the bank statements, let's say you're a realtor or something like that, and you make money and you get a 1099 at the end of the year, we can also average the last 2 years of 1099s, and we take the year-to-date bank statements. So
and look, the nice thing too, particularly about the 12-month bank statement program, is there are options for people that are self-employed for less than 2 years. There are some programs out there for those people as well. So, just the old standard, you have to be employed for 2 years and provide 2 years tax returns, is just not the case anymore. And the other thing that's interesting too, particularly as rates have moved as much as they have, I'm seeing in a lot of cases, not an enormous disparity between what interest rate they would get on a conventional mortgage with what they might get on some of these programs.
No, it's not bad. And I want to say the majority, if not all of these programs, don't have mortgage insurance, for example.
Right.
So you can have somebody that puts 10% down into one of these bank statement loans, where by the time you account for no mortgage insurance, and yeah, the rate is higher, but by the time you account for, no mortgage insurance, that disparity is not that much. And what we do with a lot of our clients is we tell them, hey, look, this is what you can qualify today based on the bank statements, or this is how much you need to declare in order to be able to qualify for the same amount with your tax returns. And yeah, the rate's a little higher, but it's not, as high as what their potential tax liability would be.
Absolutely. So that's the most popular one. This next category, and I know we just did our last episode on investors. This next one, I think I do more of than the bank statement program, and it's something called the DSCR loan, which stands for Debt Service Coverage Ratio. Now, debt service coverage ratio is a commercial lending term, and that's irrelevant. But the way this program works is you just look at the cash flow in the property. Now, this is for investment properties only, and there's some underwriting guidelines to make sure that the underwriter feels comfortable that it is in fact an investment property. But in this program, you don't look at personal income taxes at all. I mean, the basic premise is if you're buying a house as an investment property and the mortgage payment is $2,000 a month and you're going to bring in $2,500 a month, why would you ever let the property go bad?
Yeah, this is one of my favorite ones because it really underwrites based on the actual investment. So it's a true investment loan. There's a lot of cool things about this program because you have the ability of buying the property in the name of an LLC, for example, which give you that extra level of protection. There's also cases where the house doesn't need to necessarily pay for itself because, they do understand that it's an appraisal going out and getting a sense of what the market rent would be. So there's a lot of cases where even if you go below a 1-to-1 ratio, they can still qualify. So yeah, I agree with you. This is probably the most popular that we're getting right now. I think the fact that you can close in the name of an LLC is huge, and it just makes sense. I mean, when you buy an investment property, you just want the investment to make sense. And if you have a big down payment, then that's if you have a good cash flow, then that should be most of the basis of the qualifications. Now, having said that, we do have to look where the money comes from, and you have to have, a certain amount of credit depending on the program and whatnot.
Yeah, and look, before, if you listen to this and you think, wait a minute, this is crazy, this is literally how the entire commercial lending industry works.
Yeah.
Commercial loans are based 100% on the cash flow of the property. So this is not this like newfangled idea that came out. It's it's the way the whole commercial lending world works. So the DSCR loans, and that's why they term it as that, what they use a commercial term for to describe it. So the DSCR loans are a really, really, really good option for people that are having trouble making the numbers work otherwise.
Yeah, I'll give you an example. I mean, this is the type of investors that you get with things like that. I have a guy that owns a beautiful house up north of about $5 million. He got big what is it called, like a severance package, because they bought out his company and they told him, hey, you can stay with us and we'll pay you a 2-year salary, or we'll actually part ways and give you this much. So he went through that. He's in the process right now of buying 2 different businesses, and when all of this happened, he has 4 duplexes right now in this area of Florida. And he talked to me and he's like, look, I understand that right now, technically, all you guys see in the lending world is somebody that's unemployed, even though I have my assets and I have all of this. And I don't really want to touch my assets or do anything with liquid assets that I can show because I'm in the process of buying 2 businesses. So I really can't do any type of asset depletion or anything like that. And I mean, he has, his primary residence, but he has these 4 duplexes, and we were able to do a cash out refi in the form of a DSCR for 2 out of his 4 duplexes. And it was one way for him to tap into that equity. And, I cannot think of a more qualified buyer than him. Yet, again, for a Fannie, Freddie, conventional,
No
government
chance.
product, all we see normally is just somebody that's unemployed.
Yeah. So what's the next one you want to talk about?
Well, I want to talk about something that's similar to that DSCR program, and this is one that we're doing a lot. I'm doing a lot, and is the foreign national loans, right? Normally, the conventional, idea is in order to be able to buy a home here, you need to be a legal resident of this country, and you have to legally be able to work in the country. Otherwise, you cannot qualify. Well, there's this thing called the foreign national programs, and the foreign national programs, you get all kinds of flavors of them where we can look at income in a bunch of different ways. But basically, this is a way for somebody that doesn't live in America and it's not able to work in America to buy and invest in America. As you know, I am originally from Colombia. As much as I love my country, buying property in America and getting that return on investment in dollars today makes a lot more sense than getting that return on investment in Colombian pesos, right? Because you have to think about it. In a lot of other economies, you not only have to, when you invest in another country, you not only are investing in that asset class, but you're also investing or putting a bet in the economy of that country.
The currency.
And as much as we can, we complain about the current currency and the economy and all that, I would put more money here than in most other countries. So if anybody that's a foreign investor that's interested in buying in America, they don't have to buy cash. They can still leverage their money and buy with a foreign national program. And the foreign national program, you can actually combine with that DSCR loan, where instead of having to go through the process of proving income in that other country, we can simply really focus on the actual investment. So we're getting a lot of people from Latin America, from Canada, from any other country that's interested in buying here. So the foreign national program, guys, if you're a realtor that's listening to this right now, if you speak Spanish, French, any other language, I very much encourage you to do some videos to not only talk to the people that you have here, but talk to the people that you have in all these other countries, because that's a very hot topic right now, investing in real estate in America. So that's a big one too. So foreign nationals.
Okay, and look, I think that it's really important to set the groundwork a little bit as to why these programs are growing as much as they are right now. And although plenty of people are complaining, us included, about interest rates going up have made the advancements of these programs more possible. Because look, in any lending environment, more risk equals a higher rate of return, meaning a higher interest rate, right? If you were lending Bill Gates money, you'd be fine getting a smaller amount of money than if you were lending my 16-year-old son money. So now that if conventional rates are in the 2s and 3s, and these rates are in the 4s or 5s, well, that's not super exciting, because you can make a lot greater rate of return on your money somewhere else. But now that interest rates are where they are, and some of these programs might have interest rates in the 7s or 8s or higher, now all of a sudden there's a kind of like enough juice in there for it to make sense for people. So I know these programs have expanded a lot lately, and I predict they're going to continue to expand. Again, we're not going to go to the stupid level, because a lot of federal laws were passed that made it impossible for the subprime nonsense to happen again. But I do think there's going to be some more options, and some of those options have to do with money being funded to builders and some fix and flip money. I wanted to talk about that a little bit.
Yeah, this is one that I'm extremely excited about. We're currently doing 3 right now, and it's the fix and flip loan. Again, that's another thing that has not been an option in your regular, normal programs. And, the conventional wisdom on lending is you buy a property to hold it at least a year is what, most lenders want you to hold the property for. So, there's not a lot of options for somebody that wants to buy, repair, and sell it. So now there's fix and flip programs where they're actually pretty aggressive. You can buy a house with as little as 10% down. If you are an investor that has done flips in the past 3 years, more than 7 flips in the past 3 years, the down payment can go down to even 7.5%. And the underwriting is purely based on the actual project, which makes sense, because the idea here is that as long as the project makes sense, and obviously you have to show the property, you have to say what you want to do to the property, you have to, kind of like put some numbers together. The bank will also do an appraisal on the property based not only on the current value, but on the value when you're going to sell the property after you fix it.
The subject to.
After the subject to. They lend you the money not just to acquire the property, but also to fix the property. So these ones are super cool because you can buy in the name of an LLC. And again, if you are somebody that have a good eye for this type of investments, well, you can partner with somebody, or you can do it yourself, or you can actually get the money to do something like that. That program is interest only for 12 months, and you have those 12 months to, get that property wherever you need to get it, and then flip it. And then basically a version of that is being rolled out to builders too, where the builder can go in and, basically in a plot of land, show what they're going to do or show the building that they're going to do to the property, then use that money to build the property and then, basically sell it to anybody and they can rinse and repeat. So those are two exciting programs that we just, recently rolled out and that are coming soon. And, there's a big niche, and depending on the market you're in, flips. I know, for example, there's an area in Naples where there's a lot of flips happening right now, and we're seeing a lot of concentration of investors there.
That's perfect. Now, I don't know if there's any other non-QM programs you want to talk about, but another thing, and you've touched on this briefly earlier, that I think needs to be discussed is down payment assistance.
There's one that I want to talk about, one more than we have, and that's a program that has been pushed by one specific bank, and is this all-in-one program. This all-in-one program is basically one big line of credit for your house. And again, without getting too specific, the idea behind it is you combine what a regular mortgage would be with a line of credit. So you take a line of credit that's first position, you have to connect a checking account to this line of credit. So, every time that you get paid, there's a portion of that money that you get paid that goes towards that line of credit. But the cool thing with this is that since the basis of it is that being a line of credit, if you have a house that's appraised at, $500,000 and they can give you a line of credit of $450,000, as you pay off that mortgage, you have the ability to take out that amount of money that you've been paying off to invest money and to do other things. So that's another one that's fairly new. I hear a lot of people talking about it, and it might not be as widely used as the other ones that we talked about, but for the right person, it might be a good option.
Yeah, and I just want to throw a word of caution out about that program, because I think that a program like that is only right for somebody who is rather financially sophisticated and quite financially disciplined. Okay, the problem I have potentially with that program is that the average American walking around is not, financial literacy is not taught, right? And the average person walking around at all socioeconomic levels is not necessarily a financial guru. So that's
an understatement.
So giving them kind of untethered access to their home's equity like that could really blow up in their faces to some extent. So if you're listening to this, ask yourself, am I really good with money? If you're, and be honest with yourself, if the answer is no, that all-in-one program may not be the right program for you.
Yeah, I have to say that's a program that the main goal of somebody using that program, and this is, again, talk to your lender, talk to us. We as lenders, me and Scott, we have very strong opinions about a lot of these things, and we share them, and ultimately we give you the advice, but we have opinions about it, and that's what an advisor does, right? This one particular program is more directed to people that want to pay off their house very, very fast, but they don't want to lose the access to that equity in case they ever need it. So if you are of that mindset and your main goal is to pay off your house very, very, very fast, but you don't want to lose out on the access to that equity, that might be the program for you, but it's not the right program for what I think Scott is alluding to, which is using your house as a credit card, because that's a disaster.
Yeah, that's gonna end poorly quickly. So, all right, let's transition over to DPAs. Okay, so down payment assistance programs are
dead.
Very popular now. And look, as house prices have grown, just 3.5% down, just 3% down, just 5% down has turned into a much bigger number.
Yeah, for sure.
And it's, I did a video on Facebook, and don't quote me exactly, but like in the last quarter, American credit card debt increased something like $64 or $67 billion in 3 months. Like, that's a catastrophically bad statistic. And the main part of the article I was reading was how much student loan debt had gone up, which was, with all these forbearances and stuff, was a lot. But man, 60 plus $60 billion in a quarter in credit card debt, like that's some bad news. So this recession has put a big strain on people's finances. COVID has put a big strain on people's finances. Home prices jumping up has put a big strain on the down payments, and DPAs are more popular than ever. And I know in Florida, they recently launched, and I know it's not just the Florida program, because I know they have a similar program in other states, but Florida launched something called Hometown Heroes.
I don't know about the other states. This is an awesome program that we have here in Florida.
It is.
It's a great program. Yeah, the Hometown Heroes program is probably the most popular down payment assistance program in Florida right now. And I mean, I freaking love it. I think it's a great program. You get 5% of the loan amount up to $25,000. So technically, if you can get up to $25,000 that you can use for the down payment and for closing costs. So if you're a first-time home buyer that needs to put 3% down on a property, you're going to have an extra 2% to pay for closing costs, which again, if you get $25,000, should cover the majority, if not all, of those closing costs. And this program is good for, anybody that's the first responders, like firefighters, police officers, nurses, teachers. Like it's a broad
list of occupations. And I want to, the ones you touched on are the ones everybody touches on, but I've had a lot of success in looking. I think there's a total of 72 professions. So, dental hygienists, veterinary technicians, like there's quite a long list of professions. And I've had a lot of success in talking to people outside of the standard first responders, teacher, medical list where everybody's brain goes when they hear the word heroes. There's lots of other heroes out there, and this program tries to encompass all of them. So that's a really, really good program. Now, it's funny, so the $25,000, the up to $25,000 you get sits as a lien on the property, 0% interest, and you have to pay it back.
0% interest, guys. You get you can get up to $25,000, 0% interest.
And what's funny is I have people complaining like, oh wait, I got to give it back. I'm like, there's no such thing as free money. So look, in a lot of it, there's no point in us going through the names of all of them because somebody can list this 3 years later and it could change. But the one thing I like to tell people with the down payment assistance is that there's no such thing as free money. So if the, quote unquote free money, if that money is forgivable, you're almost definitely going to pay a higher rate on the mortgage, all right, on the first mortgage. So, when I'm doing an analysis for a person, how much higher is the rate? What is that going to cost in interest? And what is the quote unquote cost of that money? So, there's no free ride, which is why, I agree with Ed, the Hometown Heroes thing, you're paying it back at 0% interest. And by the way, it has to be paid back when you either sell or refinance the home. So you could theoretically buy a house, live there for the rest of your life and, not have to pay it back. But there is a lien that doesn't grow of a kind of static dollar figure that sits there. So down payment money with the Chinoa Fund, I know I just said not to mention names, and I am, but that's a nationwide event. And then a lot of the states and municipalities have their own individual unique programs. So look, if you have a client that doesn't have down payment money, look into those. Another program worth talking, actually 2 programs with FHA that are worth talking about is the $100 down program and the Teacher Next Door program.
Yeah. Okay. Right. Yeah. Why don't you talk about that HUD program? Yeah.
So
that's insane.
Yeah. So both of these programs, you have to be buying a home that was foreclosed on by HUD. Okay. It's referred to as a HUD repo. And there's a thing called HUD Home Store where you could go and look at what's out there. And please,
these are all real words, guys. He's not making up words.
Please do not think that a HUD repo is a distressed property in a particular area of town. I bought the house I'm in now originally with an FHA loan. I've bought several houses with FHA. I do plenty of $300,000 and $400,000 FHA loans now. And, so just get that stigma out of your head. But if a home is a HUD repo, you can get a regular FHA mortgage and the down payment is literally $100. There's no catch, there's no angle, it's just $100. So if the sales price is $400,000, the loan amount is $399,900. So that's a really, really, really cool program. Also in that program, if there is some work that needs to be done, you could actually finance, like add that to the loan amount. So it's in theory, if you're buying a $400,000 house with $5,000 worth of repairs, you could get a loan for $404,900. So $100 down and the rest of it's finance. So that's a really, really neat program. The second program is mind-blowing, is the Teacher Next Door program. And here's how this works. Now, the Teacher Next Door program, it needs to not only be a HUD repo, but it does need to be in certain areas. And the way it works is if you're a first responder or somebody of that nature, you can literally buy the house for 50% of asking price. So if the house is $400,000, you could buy it for $200,000. And that other $200,000 sits on a lien, as a lien on the property, I want to say for 5 years. And as long as you live in that house for 5 years, it might be 7, but around there, the lien is forgiven. So you could literally buy a house for half price. It has to be in certain areas. It has to be a HUD repo. It has to be certain occupations. So this is not a one size fits all thing. But if you're working with somebody, I mention this in my seminars, and 95% of the room has never heard of it. So if this is new information to you, get with your local lender, give us a call, and get knowledgeable on this, because it's really an interesting way to help a lot of good people that need help in this market.
One more program I want to throw out there, because we get a lot of questions, especially, all my Latin community, is the ITIN loans. There's still options for people that, they don't have a social security number, but they have an ITIN. Very different than options for people that have social security numbers, but there's still options out there that would fall within these categories. And this is the thing, guys. The main takeaway with all of this is there is a lot more options that maybe you're accustomed to here. These are the downside with all of these programs is those are programs that, because they're not conventional and government loans, the guidelines change and they move quite a bit, and you need to be working with a lender, you need to be working with realtors that are knowledgeable about these type of programs. Unfortunately, the majority of the lending industry is full of people that not only they've been doing this forever, but they've been doing it in one way, and they don't like to get into things like down payment assistance programs or this type of creative financing. And that's why, a lot of people just get turned away when they fall within these categories. But there's options out there. And like we always tell people, look, if you're a client out there, make sure that you go to the right resources. And if you're a realtor listening to this, we probably talked about at least 1, 2, 3 programs that you had no idea about. Think of all the people that are not in the industry. Think of all the people that have been turned away that maybe fall within in these categories, and all the business that you might be able to, reach out to, and all the business that you might be able to get just by knowing that there's options for people like this.
Look, man, I think this is a lot of good information. So look, let's wrap it up. I think we're in good shape here. I'm Scott DiGregorio.
Edgardo Balentine.
This is the Real Estate of Tomorrow podcast. Tell all your friends about it, and I will see you soon.
Well, thank you guys for listening. And now it's your turn to implement everything you learned today.
Look, you have a question, you have a topic for a future episode?
Share with us.
Yeah, tell us what you're doing. What are you doing today so you could be successful tomorrow? Send us an email at success@realestateoftomorrow.com.
And don't forget to leave us a review, an honest review.
Screw an honest review. Leave us a 5-star review. And for every 5-star review we get, we're going to send you a badass Real Estate Meme t-shirt.
Those shirts are hilarious.
See ya.